and welcome to Asset TV. I'm joined now by Sara Moreno, Emerging Markets Equity Portfolio Manager, and Albert Kwok, Emerging Markets Equity Portfolio Manager. Sara, starting with you, what's the investment philosophy of the Jennison Emerging Markets Strategy?
Yeah, so we believe that in the long run, growth drives returns in emerging markets. We believe that finding companies with sustainable long duration growth is the key to generating alpha in the long run. We focus on growth because our analysis has shown that over time, companies with a superior growth profile get a disproportionate share of returns. So we focus on growth because growth is not evenly distributed across all emerging market companies like it once was. And so a rising tide will no longer lift all boats. We focus on looking for the pockets of growth that exist within emerging markets. So our agnostic and concentrated approach gives us the flexibility to shift to where we see growth opportunities emerge in emerging markets, and thus allowing us to focus on companies with a unique and sustainable competitive advantage.
Albert, turning to you, what would you say are the key characteristics of the Jennison Emerging Markets Strategy?
I think the key distinction between us and our peers is that we don't look anything like the emerging markets index. Our investment philosophy is about finding a small subset of fast-growing companies within the EM universe through fundamental bottom-up research. And we build our portfolio one stock at a time. We are benchmark, sector, and country agnostic because we believe that taking an active, concentrated, and unconstrained approach is the best way to help our clients generate alpha.
That's interesting, Albert. Can you comment further on how you don't look like the EM index?
Sure, Jenna. Historically, investors were drawn to the EMs because they wanted to access superior growth. But over the past decade, despite these wonderful promises like young demographics, high rate of urbanizations, and an expanding middle class, they have been disappointed with the performance of the asset class. However, at the end of the day, when you look at the GDP growth of EMs, it has been consistently faster than the developed markets. So what is the disconnect? If you look at the components of the benchmark, they represent the old economy, what I call the X-growth sectors, with very high concentration in financials, energy, materials, and industrials. As a matter of fact, today they still make up 45% of the index. Not much different from the 50%, over a decade ago. The EM playbook has changed. Time has changed. Many of these sectors are fundamentally challenged, and the MSCI EM index no longer captures the dynamism, the opportunities that exist within the emerging markets. So when we designed this strategy from the very beginning, 6 years ago, we wanted to change all that. We wanted to focus on the basics, the very reason why investors are looking at emerging markets to begin with, which is high growth and high returns. So our approach is about tapping into the structural growth that EM offers. We look for high growth, high return companies and sectors that can offer investors the classic EM characteristics that they are looking for. For an example, healthcare, which is less than 4% of the index, it makes up nearly 27% of our portfolio.
Yeah, and Sara, can you give us a flavor of the types of companies you're looking for?
Yeah, sure. So when you look at the entire emerging market universe, it comprises over 2,000 companies. But to Albert's point, we are focusing on very specific and very special type of companies, namely those that can achieve a higher growth profile in the longer duration of that growth. So we focus on a narrower universe, a subset of companies, because the majority of companies in emerging markets have sort of pedestrian growth profiles. So we look for 4 key characteristics. The first and most special one is disruptive technologies. These don't come around often, but when they do, they tend to have a long growth direction cycle. So it's very interesting. The second is new product cycle, and these can be found across emerging markets. The third is a large addressable market, and this is also unique to emerging markets because you have that demographic dividend, that rising income, that emerging middle class, rising incomes. So those present some very interesting opportunities. And finally, we carefully look at management and their ability to execute on their strategy. So once we identify a company that is, serving an unmet need or serving a large consumer base, creating a new product cycle, we try to figure out if there's that company's building a moat, creating competitive advantage versus its competitors. And then if they are, we move meaningfully. And so what that results in is that we tend to be early into the secular trends that are occurring within emerging markets. And so that has taken us more into segments like e-commerce, fintech, payments, and healthcare. While we don't ignore the macro considerations that one has to have when one invests in emerging markets, we overlay these over the companies that we're considering. So, we take a lot of time in consideration to geopolitical concerns, macroeconomic risks, currency risks. And if a company that we're considering has any of these risks, they need to have a higher growth profile in order for us to warrant taking those risks.
Albert, why focus on growth within emerging markets?
We focus on growth because our analysis shows that over time, earnings win. Earnings ultimately drive stock prices. Companies with superior and sustainable earnings growth get the lion's share of outperformance. Now, you cannot just buy the asset class passively and call it a day. So therefore, we spend all of our time and energy trying to identify these emerging trends early. And we build a concentrated portfolio with the best companies within these growth pockets. So over time, growth trends, they shift around, but our benchmark agnostic approach gives us the flexibility to move on to the next big opportunities without being constrained by the benchmark.
Sara, what would you say differentiates the Jennison EM Equity approach from its peers?
We're more focused on the growth component from a bottom-up fundamental approach. So we look to generate alpha by investing in market leaders across emerging markets, especially when these leaders are tapping into the structural growth that emerging markets offer. So that combined with our high concentration, we typically have 35 to 45 names versus a universe of 2,000, this leads us to do a different type of research than our peers. We spend more time focusing on what is uncorrelated and differentiated, and we seek to understand what the market isn't considering about these companies. So this often leads us early into secular themes and leads us to focus more in the higher, more dynamic sectors of emerging markets, which are more in consumer, healthcare, and technology.
And Sara, despite EM economies growing faster than developed economies, why do you suppose investors are often disappointed with EM equity returns?
This has been very frustrating for investors because the reason they're looking to invest in emerging markets in the asset class is to access the higher growth profile of EM economies. We find the dynamism and opportunity within emerging markets in companies that are serving the consumer base, the large middle class, serving an unmet need. And so we focus on the pockets of growth that one can find in EM. And often these pockets of growth can be very significant and have long duration growth. And the companies that are in these pockets of growth have to have a sustainable competitive advantages for us to consider them for the portfolio.
Albert, over to you. Can you comment on how the portfolio is currently positioned?
Well, in general, we love disruptive technologies. You don't find them too often, but when you do, we're all over them. We like companies with new product cycles. We like underpenetrated or expanding markets. We are also opportunistic with growth cyclical companies. Now, at present, the majority of these ideas can be found in the healthcare, consumer, and the technology sectors. The COVID pandemic has caused the consumers to change their behavior quite rapidly, and we're seeing acceleration in many trends. Notably, grocery delivery, e-commerce, cloud computing, online video, online educations, gaming. We've noticed that, internet adoption is increasing rapidly among the lower tier city population and the older demographics. So, we are also seeing, more resources to be allocated to the healthcare sectors and public health. So our in-depth research effort has led us to be early investors into many of these secular trends across EM. And we believe that many of these changes will be structural and not temporary. We continue to avoid financials, materials, energy, and industrials. They have lagged during the strong stock market recovery since the end of Q1. And we think that they're still quite vulnerable as the COVID pandemic might have long-lasting implications to their fundamentals.
Now, taking a closer look at the healthcare sector, Sara, unlike the EM index, you have a higher weight within healthcare. What led you to this segment of the market, and what opportunities do you see?
Yeah, we were early to this as we saw the opening up of the China healthcare market created a unique investment opportunity. So how this came about is, the Chinese government faced sort of twin pressures. One is the aging of its population, and then a high incidence of high burden diseases such as cancer. So the Chinese government moved proactively to create incentives to bring innovation and innovative therapies into its healthcare market, which up until 5 years ago was dominated by cheap generics. So we focused rapidly on the subsegment that was most able to address the unmet need of the Chinese high burden of diseases like cancer. And so it led us to the burgeoning biotech sector within China, where we see a multi-year growth opportunity given the large unmet need of the Chinese population. To give you some context, China every year has over 4.3 million new cases of cancer every year. So the incidence burden is very high. This is twice the rate of the United States. So by following and putting through several reforms, you're having an acceleration of innovation across the Chinese healthcare market and allowing China to slowly start to tackle the high burden of cancer and chronic diseases across its population. We can observe this in the flow of clinical activity that has occurred in the Chinese healthcare market. In 2019, Chinese companies delivered over 200 new innovative asset filings for clinical trial into the Chinese FDA, and this compares to around 90 in 2014. So the acceleration has been very rapid. To sort of put this in context, we expect the acceleration to continue in the Chinese healthcare market despite COVID. There'll be more resources put forth by the Chinese government and all governments across the emerging markets post-COVID, but we already saw these trends earlier, pre-pandemic, and that sort of speaks to our investment philosophy and fundamental bottom-up approach. We could see that the Chinese healthcare market was going to be a long-dated secular growth opportunity as the Chinese government spends only 5% of GDP on healthcare versus a developed market peer like the US that spends 17% of its GDP in healthcare. So we see lots of opportunity there. And like I said, it speaks to our strategy that we were very early to this opportunity.
And moving forward, Albert, how do you see the future of emerging markets? Where are the opportunities, particularly as emerging markets navigate COVID-19?
Well, to be honest, in the near term, we are cautiously optimistic. COVID-19 is still a fluid situation, and there are still many unknowns. But here are what we know. So point number one is that there are certain EM countries that are ahead of the curve in containing the pandemic. And there are some that are way behind. Point number two is that there are tremendous amount of policy and monetary responses enacted by the governments across emerging markets. Number three is that COVID-19 has accelerated a number of trends that were already happening prior to the pandemic, such as the shift from offline to online, digital payment, increasing investments in healthcare, and so on. The last point is that the pandemic has exacerbated geopolitical tension, but at the same time accelerated the race to localize supply chains. So we see many companies who would benefit from this trend. Against this backdrop, we believe that as uncertain as the future is, there will always be winners and losers, and investors can still generate alpha by investing in many secular trends. Longer term, though, we have a very constructive view on the emerging markets. We know that the recovery from the pandemic might take time. However, we are certain that the emergence of a growing middle class will continue. The next 1 billion consumers entering the middle class over the next 5 to 6 years will be coming from emerging economies. This will create many compelling investment opportunities, and we will follow this middle class. Also, this explosive growth of middle-class consumer has helped drive innovations throughout the emerging markets. Many EM companies have moved away from being just low cost and low value added exporters to being innovators. I think the beauty of our approach is that it is designed to capture the new waves of innovations and disruptions. Future growth opportunities might be coming from entirely unexpected sources, but because we are unconstrained and flexible, we are always looking to capture new growth opportunities wherever they arise.
And finally, Sara, what are some of the risks that you see to the outlook for emerging markets?
Yeah, so excluding COVID-19, which remains a fluid situation, something that we are keeping our eye on is, the increased geopolitical tensions that are occurring and the rise of populism across the globe. So we're mindful of these factors as we assess the companies and the regions that they're located in, or the regions that the markets that they're serving. And so while for something like the decoupling that we're seeing of global trade isn't optimal, we believe that there will always be winners and losers, and new supply chains will form to serve the local needs. Localization that may happen will create winners and losers. And so we believe that opportunities in emerging market remain rich, and they will happen regardless of the economic and political backdrop. And that's the advantage of our flexible and unconstrained approach.
Well, Sara, Albert, great to have you. Thanks for joining us.
Thank you, Jenna.
Thank you, Jenna.
And thank you for watching. I'm Jenna Dagenhart for Asset TV, and I was joined by Sara Moreno, Emerging Markets Equity Portfolio Manager, and Albert Kwok, Emerging Markets Equity Portfolio Manager.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.